Hello, friends. If you are collecting Social Security and still working before full retirement age, the number you need to know in 2026 is $24,480. Earn more than that while you remain under full retirement age for the entire year. And Social Security can withhold $1 of benefits for every $2 above the limit. But that headline leaves out 4 facts that change the answer for thousands of people. The limit does not apply after you reach full retirement age. A different, much higher limit applies during the year you reach that age. Pensions and investment income generally do not count, and benefits withheld because of work are not necessarily gone forever. The problem is that Social Security often withholds whole monthly checks to collect the required amount. So a person who expected a small reduction can suddenly see one or more checks disappear. Today, I am going to explain exactly what counts as earnings, what does not count, how the $65,160 rule works in the year you reach full retirement age, why the first year of retirement has a special monthly rule, and what you should report before an incorrect estimate creates an overpayment or unexpected withholding. Stay until the end, because the difference between wages and retirement income is where many people make the biggest mistake. Before we begin, subscribe and turn on notifications. Social Security rules are full of numbers that change each year, and one old number can ruin an otherwise good retirement plan. I use current Social Security Administration guidance and explain it in plain English. Let us start with the basic 2026 rule. If you are younger than full retirement age for all of 2026, the annual earnings limit is $24,480. For earnings above that limit, Social Security withholds $1 in benefits for every $2 over. Suppose your wages for 2026 are $30,480. That is $6,000 above the limit. Social Security would calculate $3,000 of benefits to withhold. That does not always mean each monthly payment is reduced by exactly $250. Social Security may withhold entire monthly benefit payments until it has withheld the required amount, then resume checks. That collection method is why the rule can feel more severe than the formula. Imagine your monthly benefit is $1,500 and the withholding calculation is $3,000. Social Security may withhold 2 full monthly checks. Now imagine the calculated withholding is $2,000 with the same $1,500 monthly benefit. Social Security may initially withhold whole checks and later reconcile the difference, depending on the payment schedule and final earnings. The exact timing can vary, so do not build a household budget around a perfectly smooth monthly reduction. Now we need to answer the most important question: what counts as earnings? For an employee, Social Security generally counts wages from work. That includes items such as salary, hourly pay, commissions, bonuses, and vacation pay when treated as wages. For a self-employed person, Social Security generally counts net earnings from self-employment, not gross business revenue. That distinction matters. A business may collect $50,000 from customers but have $30,000 of deductible business expenses. The relevant self-employment figure is not automatically the $50,000 deposited into the business account. Now, what does not count toward the retirement earnings test? Social Security says it generally does not count pension, annuities, investment income, interest, capital gains, veterans benefits, or other government and military retirement benefits. This means a person can have income above $24,480 and still not exceed the Social Security earnings limit if the income is not wages or net self-employment earnings. For example, a retired worker receives $18,000 of wages, $20,000 from a pension, and $10,000 of investment income. The person's total cash income is $48,000. But for the retirement earnings test, the wages are $18,000. Below the 2026 limit, the pension and investment income generally do not count toward this specific test. Do not confuse the Social Security earnings test with federal income taxes. Pensions, investment income, retirement account withdrawals, and taxable Social Security can affect your federal tax return even when they do not count toward the earnings test. These are separate systems with separate definitions. There is also a timing rule. When you work for wages, income generally counts when it is earned, not necessarily when it is paid. That matters when a final bonus, accumulated vacation pay, or severance payment arrives after retirement. Some payments received after retirement were earned before retirement and may be treated as special payments rather than current earnings for the annual test. Do not assume payroll reporting will automatically explain the situation correctly. Keep pay stubs, employment records, and letters showing what period the payment covered. Self-employment has its own timing and work activity rules, especially under the special monthly test. If you run a business after claiming benefits, hours, and the nature of your work can matter in addition to reported net income. Now let us discuss full retirement age. Full retirement age is not automatically 65. It depends on birth year. For people born in 1960 or later, full retirement age for retirement benefits is 67. People born earlier may have a full retirement age between 66 and 67. You need the exact month, not just the age. The special earnings rule changes beginning with the month you reach full retirement age. If you reach full retirement age during 2026, a different annual limit applies to earnings in the months before your full retirement age month. That higher limit is $65,160. Social Security withholds $1 for every $3 earned above that amount, and it counts only earnings before the month you reach full retirement age. Suppose you reach full retirement age in August 2026. For this higher limit calculation, Social Security looks at earnings from January through July. Earnings from August through December are not limited by the retirement earnings test, because beginning with the month you reach full retirement age, you may earn any amount without reducing retirement benefits under this rule. Here is an example. A person reaches full retirement age in August and earns $68,160 from January through July. That is $3,000 above the higher limit. At $1 withheld for every $3 over, the calculated withholding is $1,000. The same person could then earn additional wages after reaching full retirement age without those later wages reducing benefits under the annual earnings test. That is dramatically different from applying the $24,480 limit to the full year. This is why using the wrong limit can create panic. Someone may see annual wages of $80,000 and assume nearly $30,000 of benefits must be withheld. But if that person reached full retirement age during the year, only pre-full retirement age earnings are measured against the higher limit. Now, let us address the special rule for the first year you retire. A person may retire in the middle of a year after already earning more than the annual limit. Without a special rule, that person could lose benefits for the rest of the year even after stopping work. Social Security has a one-year monthly earnings test, usually used during the first year of retirement. In 2026, a person under full retirement age for the entire year can generally be considered retired for a whole month when earnings for that month are $2,040 or less. Under the special rule, the person may receive a full Social Security check for a whole month considered retired, even when total annual earnings exceed $24,480. Imagine someone earns $45,000 from January through October, retires at the end of October, and earns only $500 in each of November and December. The annual wages are far above the annual limit, but the monthly special rule may allow benefits for November and December because monthly earnings are below $2,040 and the person is considered retired. For self-employed people, Social Security also looks at services performed in the business. Generally, working more than 45 hours in a month can mean the person is not considered retired. Working fewer than 15 hours generally supports retired status. Between 15 and 45 hours. The skill level and management responsibility can matter. This is one of the most technical areas in the entire earnings test. A self-employed person should not rely only on a tax return estimate. Keep a calendar of hours, duties, customer activity, and management work. Now, are benefits withheld because of work loss forever? For retirement benefits, Social Security says it recalculates the monthly benefit at full retirement age to give credit for months in which benefits were withheld because of excess earnings. That means the withholding is not the same as a permanent forfeiture dollar for dollar. The original early claiming reduction was based partly on the number of months benefits were expected to be paid before full retirement age. If Social Security later withholds checks because of work, it adjusts the reduction factor at full retirement age. The result can be a higher monthly benefit going forward. That does not mean you receive the exact withheld dollars immediately as a lump sum refund. It means the monthly benefit is recalculated to account for withheld months. And there is an important exception. The treatment of auxiliary benefits can differ. Spouses and survivors receiving benefits because they have a minor child or child with a disability in their care may not receive the same increase at full retirement age for benefits withheld due to work. Also, disability benefits and supplemental security income follow different work rules. The $24,480 retirement earnings test is not a universal work limit for every Social Security program. Now let us talk about working after claiming. Continuing to work can sometimes increase your underlying Social Security benefit, independent of the earnings test. Social Security reviews earnings records for beneficiaries who work. If a new year of earnings replaces a lower year among the 35 years used in the retirement benefit calculation, Social Security can refigure the benefit and pay any increase due. So work can have two effects at the same time. Before full retirement age, current wages may cause temporary withholding under the earnings test. Later, those same wages may increase the benefit if they improve the earnings record. That is why the decision is not as simple as never work while receiving Social Security. The right question is whether the wages, taxes, benefit, withholding, future recalculation, health insurance, and personal goals make sense together. Here are the most common mistakes. Mistake number 1 is counting every dollar of household income toward the earnings test. The test generally counts wages and net self-employment earnings, not pensions, interest, investments, or capital gains. Mistake number 2 is using the $24,480 limit during the year full retirement age is reached. That year has a $65,160 free full retirement age limit and a 1-for-3 withholding formula. Mistake number 3 is counting earnings after the full retirement age month. Beginning with that month, the earnings test no longer reduces retirement benefits. Mistake number 4 is failing to use the first year monthly rule after retiring mid-year. Mistake number 5 is assuming withheld benefits are permanently gone. Retirement benefits are recalculated at full retirement age to credit withheld months. Mistake number 6 is giving Social Security an outdated earnings estimate. Social Security adjusts benefits based on the estimate you provide. If your work hours increase, you receive a bonus, or you stop work earlier than expected. Report the change promptly. An estimate that is too low can lead to overpayment and a later demand for repayment. An estimate that is too high can cause unnecessary withholding and a later correction. Mistake number 7 is forgetting that family benefits can also be affected. Earnings on the worker's record can reduce benefits paid to family members based on that record in some circumstances. Here is the checklist I recommend. First, find your exact full retirement age and month. Second, decide which rule applies under full retirement age for the entire year. Reaching full retirement age during 2026 or already at full retirement age. Third, separate wages and net self-employment earnings from pension, investments, interest, annuities, capital gains, and other non-work income. Fourth, estimate total 2026 countable earnings. Fifth, calculate the excess above the correct limit. Sixth, divide the excess by 2 if you are under full retirement age all year, or by 3 if you reach full retirement age in 2026 and are calculating pre-full retirement age earnings. 7. Ask Social Security how whole check withholding will be scheduled. 8. Report any change in your earnings estimate right away. 9. Keep records of special payments and the period in which they were earned. 10. If retiring mid-year, ask whether the special monthly rule applies. You can review the official publication, How Work Affects Your Benefits. Use the Social Security Earnings Test Calculator, or call Social Security at 1-800-772-1213. The central message is simple. In 2026, $24,480 is the annual earnings limit only for people who remain under full retirement age for the entire year. It is not a total income limit. It is not a tax threshold. It is not the correct limit for someone who reaches full retirement age during 2026. And it does not apply beginning with the month full retirement age is reached. Check the rule before accepting extra shifts, starting a part-time job, or assuming your checks will continue unchanged. Share this video with anyone who claimed Social Security early and is still working. One correct earnings estimate can prevent months of confusion. Subscribe for verified Social Security, Medicare, retirement, and tax updates explained in plain English. I will see you in the next video.